Well, hey, good morning and great to be with you. Happy New Year and hope everyone's staying warm. That's particular interest to me as we got hit with about 1.5 feet of snow here recently in Kansas City as I look outside my window. We've got a jam-packed hour today, so let's hop right into it. 6 major topics we're going to be covering today. I hope that you as viewers have a baseline understanding of ESG and sustainability, but we'll cover some of the basics as well, so don't worry. We're going to launch first and foremost into exactly what ESG assurance is, why it matters, the various levels, right, and then typical assurance procedures. We'll wrap up with internal controls over ESG and then spend some time on CSRD, the EU directive that does impact non-EU companies as well. And don't worry too much on taking notes. Slide will be available after the webinar. A couple other housekeeping notes. I'm just going to reiterate what the intro video says for anyone joining a minute or two late. Hopefully you're taking advantage of your New Year's resolution to start off the year right with CPE. So please respond to at least 3 of the 4 polling questions. We'll do our best to alert you when those are coming through. And then you'll need to be logged on for a minimum of 50 minutes. One last housekeeping item, we want this to be interactive. Please utilize that chat function to submit questions. We'd welcome the opportunity to discuss areas of particular interest to you. And for any questions that we don't get to during the webinar, we'll follow up with you individually after. So you know who you're talking with today. My name's Nate White. As I mentioned, I'm currently freezing here in Kansas City, Missouri, and I look forward to the warm front. I'll use quotations of 40-degree weather here on Friday. I'm a CPA by trade, and my responsibility at Forvis Mazars is to lead our ESG assurance practice. I really love working in this space. I feel I learn something new every day and hope that we can teach you a few things during our time together. Steve?
Thank you, Nate. Good morning and good afternoon, everyone. I'm Steve Wilkerson. I'm a senior manager in our ESG and climate risk team. I'm based out of Denver, Colorado, where it's 18 degrees currently. And I'm also a CPA and focusing on ESG assurance. Michelle?
Thanks, Steve. Hello, everyone. My name is Michelle Olkers. I'm based in the London office, also cold here. But as you can hear from my accent, I'm from South Africa. I moved to the UK about 2 years ago. To focus on sustainability. I'm also a chartered accountant by background, but I focus now mainly on assurance within the sustainability world. Good to be here.
Wonderful. Thanks, Steve and Michelle. All right, let's start with the basics. To begin our day, what is ESG assurance? Some of you may have already been through it. We recognize we've got a number of people on the call today, and there's going to be various levels of understanding, and hopefully at least some of you have been through the process before, but for those of you who haven't, we're going to start at the beginning. So often we use financial assurance, sometimes called or referred to an audit, as a proxy to analogize the differences. And I'll fully admit I'm a financial auditor by trade. That's what I did early on in my career. There's a lot of similarities with ESG assurance. And so we've put this slide together with a couple of columns to easily show and compare and contrast between the two. So we often see ESG assurance at the limited level, sometimes referred to as a review. And whereas in the financial world, if you see on the right-hand side, that's under reasonable assurance, sometimes referred to as an audit. We'll spend a few more minutes on this particular topic later on in the webinar. Moving to the second line, the subject matter really differs, right? Instead of providing assurance over financial statements such as balance sheets, income statements, et cetera, the subject matter could be greenhouse gas emissions, total waste, board diversity, so on and so forth. We'll give some specific samples on the next slide of various metrics. Now let's talk reporting criteria. One of the common issues in sustainability reporting is comparability. Because of that, depending on the subject matter we just discussed, right, that greenhouse gas emissions or one of the other reporting metrics, you want to ensure there's a standard reporting criteria such as GHG protocol for greenhouse gas emissions to compare against a set of definitions and standards, and that's what those numbers are audited against. The financial analogy is GAAP, right, as you see on the screen, or IFRS, or a statutory reporting standard. As for what we actually do, right, I think we're at 4 out of 5 on the list here. During review procedures, that's much more limited, right? Which makes sense given the naming, and largely are through inquiry and analytical procedures. Whereas during an audit, right, under reasonable assurance or examination under the sustainability standards, Those are more thorough procedures. This, again, is a subject that we're going to touch on a little bit more later on. And then finally, the opinion that ours or another external firm would have is worded differently between the two. There's negative wording versus the positive wording. We've got some specific examples here on a later slide. So what can you get assured, right? The above is a subset of a much larger data set, but some common metrics that we see in the industry. Well, we as an industry are very much climate first, right? Starting with that E of ESG, especially for assurance. You'll see social metrics on there as well. For those of you subject to CSRD, which Michelle is going to spend some time on later, this list grows enormously. I really like this slide. I like data, right? And so this, as you digest the slide and bars and graphs and then the definitions on there as well, I won't read all of them to you. It's showing over time that companies are moving beyond just GHG emissions. That was generally the first metric years ago that you saw companies getting assured and reporting. And the purpose here is really just highlight the trend, starting with public companies, which again, that generally will trickle down to those of you in the private sector or otherwise. And seeing that companies are moving beyond just GHG scope 1, 2, and 3 to disclosing and having assured other metrics or even beyond that. And again, for our CSRD companies in the room that are subject to that, again, that list is going to be much, much larger. And again, these slides will be able to be reviewed after if you're interested. Steve, I'm going to pass it to you.
Sounds great. Thank you, Nate. As Nate was mentioning, reporting criteria is a key component of ESG assurance. Reporting criteria are the standards and principles used to measure the subject matter. So for example, greenhouse gas protocol is typically the reporting criteria used for greenhouse gas emissions. We also see SASB, GRI, and ISO used as reporting criteria. And during that assurance process, the assurance provider is checking for alignment with that reporting criteria itself. I also want to talk about the importance of ESG assurance and why this ESG assurance is a valuable thing. So here are some benefits of sustainability assurance. The Peter Drucker quote of "you can't manage what you don't measure" is a very applicable adage for ESG reporting. But ESG assurance goes further and gives stakeholder confidence in the data and the disclosures themselves. And then here are 3 drivers of ESG reporting and assurance that we see. We're really in this transition period where ESG reporting is moving from being primarily voluntary to being primarily driven by regulation. We see CSRD, which Michelle will talk later on about, and then also the California climate laws, which we'll get into as well, as being those 2 significant regulations that we're seeing that are pushing companies to report this information. We see American companies impacted by European regulations and vice versa. We are also seeing stakeholders continuing to ask for ESG information. So one thing that we commonly see is customers asking their suppliers for ESG information, and that might include EcoVadis reporting, greenhouse gas reduction targets, greenhouse gas emission reporting, and then also obtaining assurance over that information, including greenhouse gas emissions. I'm going quick here, but here's another kind of trend graph that we have. So we're seeing a progression of more companies reporting ESG information each year. The chart shows that 340 of the S&P 500 obtained assurance in 2022. There's probably more that didn't publicly show assurance as well. But really with the California and CSRD regulations, we're expecting that almost all S&P 500 companies will be obtaining assurance over sustainability data in a few years. So ESG assurance is quickly maturing as well as ESG reporting. Additionally, we can see here that 98% of the S&P 500 companies are reporting ESG related information already. Nate, I'll hand it over to you to walk through some of the details of the California climate rules.
Hey, thanks, Steve. And Those of you who are familiar with these couple of regulations, hopefully some of the words and definitions on the screen make sense. There's a lot of data there. I'm going to leave this up for a second to make sure you have a chance to digest. But for background, a little history lesson, right? On October 7th, 23, Governor Gavin Newsom of California signed into law 2 Senate bills and 1 state assembly bill that collectively require both public and private U.S. companies that perform business activities in California to provide disclosures about their greenhouse gas emissions, climate-related financial risks, and their voluntary carbon offset, and then certain climate-related emission claims as well. I want to reiterate that this is both for private and public companies. I'll get into the definition of doing business in California here on the next slide. One thing to note here, if you followed the SEC climate rule for public companies that has been through quite a bit over the last 2.5 years and currently is in a legal stay. One difference with the California law is on September 27th of 2024, a few months ago, Governor Newsom signed into law Senate Bill 219, which reaffirms and tweaks slightly, but not materially, the bills on the screen here today. So really doubling down, saying we're going to continue and move forward with this. So seeing kind of a divergence between this and the SEC rule. So the common question that comes up is what does doing business in California mean? And we've got a couple examples up there on the screen. Unfortunately, that definition of doing business is not currently included in the rules. The other unfortunate part, outside of our control, but really making this a bit of a challenge for companies wanting to be in compliance and prepare appropriately. If you remember, your fiscal year 25, right, is going to be one of the first reporting periods subject, which for a calendar year company or for any year company, you're in your fiscal year 25 currently as of today. The California Air Resources Board, or CARB, which is the greatest acronym out there, must promulgate those regulations for the implementation of these bills by July 1st of 2025. So to put that simply is you need to comply this year, but the actual regulations aren't going to be released until halfway through. It's a tough challenge out there, and we don't have a great answer for you, but trying to share with you the best information we have. And they may develop a unique definition during that rulemaking process or rely on the existing definitions. The one update that we want to share is that California Franchise Tax Board, which is one of the analogies that we look to, has updated their website with the 2024 sales, property, and payroll thresholds of doing business in California, which is one area that a number of companies look for.
So one thing that we saw on the previous slide was information on when Scope 1 and Scope 2 emissions are required to be reported for the California rule. So we'll get into what Scope 1, Scope 2, and Scope 3 mean here. But before we do that, let's get into what are greenhouse gas emissions. So greenhouse gas emissions are those gases that trap heat within Earth's atmosphere. And typically carbon is one of the elements within the most prevalent greenhouse gas emissions themselves. So often greenhouse gas emission accounting is called carbon accounting. So there's 3 scopes of greenhouse gas emissions. Scope 1 are those direct emissions from owned or controlled sources. So that's natural gas for heating in offices. That's your company cars, the gasoline that's combusted for those cars to operate. And your Scope 2 emissions, those are those indirect emissions from the generation of purchased electricity. So the big ones there is purchased electricity. So the electricity that it takes to run your offices and your operations, those would be your Scope 2 emissions. And then the tricky and the big one is Scope 3 emissions. So Scope 3 emissions are those other indirect emissions that occur within a company's value chain, either upstream or downstream. And they include 15 Scope 3 categories. So there's a lot to get a handle around. Not all 15 categories are applicable for every company. So the first step is to go through a relevancy assessment to identify what are the relevant and the material Scope 3 categories to report themselves. And for the California rule, Scope 1 and Scope 2 emissions are required to be reported on and assured in that first year, and then you have another year for the Scope 3 emissions themselves. So with that, let's get into our first polling question. What department do you work in? So we see that ESG or sustainability teams are within different departments and organizations. Sometimes there's a department for ESG or sustainability. Sometimes they're within accounting or finance, especially with the SEC climate rule that Nate mentioned. We are seeing accounting and finance getting more involved with greenhouse gas emission reporting. Sometimes it's within risk or legal. We see that as well. Sometimes it's within marketing, especially within the voluntary reporting itself. We also have seen ESG teams within human resources. Sometimes whatever is the key material ESG topic is what really drives what department the ESG team is under. So for example, if you're a professional services firm, there tends to be a tendency to have your ESG report up through the human resource department. We've also seen operations be a department as well. Looks like we have results here now. So it looks like primarily accounting and finance is the most common department, which could also be skewed by being a public accounting firm and having more accounting and finance people within our connections. So thank you very much for submitting that information. Okay, so let's get into what is limited versus reasonable assurance. There's a few things I want to mention here. So primarily, limited assurance is the most common type of ESG assurance. Typically, you'll start with limited assurance, but then there's regulations that will push you to do reasonable assurance after a certain amount of years. So that includes the California and the CSRD regulations that we're talking about. Limited assurance is sometimes referred to as a review. That's what it's technically called under the AICPA standards themselves. And reasonable assurance is that higher level standard of assurance. So it's more involved, there's more procedures. Reasonable assurance is sometimes referred to as an examination. So those are the two types of overall assurance. We also see different types of attestation being used for ESG information. So agreed upon procedures may be helpful if an organization has specific procedures that they would like to be performed on information. We're seeing some regulators require agreed upon procedures, including the EPA. And then as you can see in this graph here, the vast majority of assurance is currently under limited assurance, but we're seeing reasonable assurance being something that companies are preparing for, and more companies are looking to obtain that as well. So let's get into what are the differences between limited assurance and reasonable assurance. Probably the most important difference is how the opinion is worded. So the opinion is that key deliverable that the assurance provider will provide at the end of the assurance engagement, which states what they did for their assurance and their level of confidence or what their opinion is on the overall subject matter. So you can see that the limited assurance opinion is negatively worded. So it says here that we are not aware of any material modifications that should be made to the subject matter in order for it to be presented in accordance with the criteria. That's different from the reasonable assurance wording that's positively worded, which states that the subject matter is presented in accordance with the criteria in all material respects. So it's that higher level of assurance is what we're seeing. There's also different types of opinions that can be had. So the wording that you're seeing here, that's an unqualified opinion, which is also referred to as a clean opinion. There's also different forms of opinions that are used when the information didn't agree with the subject matter in all material respects, or perhaps you didn't have the support for this information, or it was wrong and an adjustment was not made. So in those instances, qualified opinions, adverse opinions could be used instead of a clean, unqualified opinion. Also, the assurance procedures differ between limited assurance and reasonable assurance. So limited assurance is typically more focused on inquiring. So that's asking about information, understanding the calculation, recalculating things, and then a lot of it is analytical procedures. So instead of doing a sample of looking at 10% of invoices, for limited assurance, typically the approach is to identify what are those outliers and be really risk focused to identify what are those elements of the ESG reporting that seem off and are worth looking into. The assurance provider would then look into that information and determine whether an adjustment would need to be made, and that adjustment could be made further on. As you can see here on the right-hand part of this chart, we can see that reasonable assurance has more procedures associated with it, but also some overlapping procedures with limited assurance. In reasonable assurance, there's often more sampling. So looking at a certain amount of invoices or a certain amount of transactions or support for the assurance process itself.
Hey, Steve, maybe if you go back one slide before we hop into the polling question. Okay, that's your warning. We've got a polling question here coming in a minute. One of the things that I always like to highlight, so this is kind of the broad universe of all potential procedures. One of the things that we do, at Forvis Mazars, we take a top-based down risk approach to our assurance engagements, and there isn't a rote, we need to look at 10 invoices or talk to 5 individuals within your company, understanding that we want to focus mainly on that risk, which I'm going to talk about here in a minute. But just as you look at these, if you're subject to a limited assurance engagement, it doesn't necessarily mean that you're going to have everything within kind of that subsection. Or similarly, if you're in a reasonable assurance, it doesn't mean that everything's going to happen there. It's more of a pick and choose to address the risks to ensure that we've done our professional responsibility. So just wanted to highlight that as you think about, I think many folks on the call here may be subject to these assurance engagements in the future, so you know what to expect. All right, let's do the next polling question here. Thanks, Steve. Whoops. Did I go one too many? There we go. Okay, what is your organization doing for ESG assurance currently? So not considering researching ESG assurance, obtaining ESG assurance, or we'll give you the cop-out answer of don't know. And Steve, I'm really curious to see what this is. And Michelle, I'm curious if you have a prediction while we wait for the results to come in.
Yeah, I'm very interested myself to see, because in general, I'm going to say that I would expect most organizations to be starting to do something in this area because it's so topical. There's so much information out there that if you're not considering anything related to assuring what you're putting out, then I think, there's some way to go.
Yeah, agreed. Steve, any thoughts from you? Just waiting for results to come in.
Yeah, I think it's going to be a mix of information. We're seeing more and more companies obtain ESG assurance, and we're even seeing more companies look to public accounting firms for assurance themselves.
Yeah, agreed. Go ahead.
I was going to say, we have some questions that came in. Maybe I can try to hit one of them. One person asked, how is the kind of information supposed to be gathered? So for sustainability information, there's a variety of different data sources that come into play. So for Scope 1 emissions, you will have utility invoices that will have the natural gas consumption. For electricity, you'll have the same. For mobile emissions, thinking through how are you tracking distance of company cars or fuel used for company cars. And then for Scope 3, it's a variety of different things. A lot of times spend-based data is used for some of those Scope 3 categories. So looking at how much you spend on purchased goods and services or so on. So just wanted to hit that, but it looks like we have our results now.
Yeah, no, appreciate that, Steve. And maybe that's our topic for our next webinar is data collection and reporting in the sustainability space. Okay, so mixed bags come through if you see the results on screen. So we've got a small section, about 15% not considering ESG assurance. And then in the researching and obtaining, we're going to call that 50%. And then, a third of participants don't know. And that makes sense given This is definitely a cross-functional area, and one of the reasons we asked our first polling question was just to understand, where does this live within your organization? One thing that we found in talking with friends and colleagues and our network is that sometimes you don't know that something's going on because someone's handling it in a different department. So that's really interesting. Curious if we do this next year, if we can look back on the prior results and see now we're starting to make our own bar graph. But a great transition, as Michelle was talking about in a minute. Wanted to chat a little bit about internal controls for ESG. So anytime you're publicly disclosing information and or that information subject to assurance procedures, right, as we've been talking about, you want to ensure that really strong control environment to verify the information presented is free of error, representative of the activities of the company, and really true and faithful, right? So our suggestion is always to start with the risk. That risk of material misstatement is going to be your first step, or the what could go wrong. So common pitfall we see over time is, well, I want to start designing controls to take credit for the wonderful things that I'm doing. Our strong advice is to, again, start with the what could go wrong, that risk of material misstatement first. That's in our left-hand column. We have a number of common risks. The list is much larger, but just wanted to give you a taste of that. And then on the right-hand column is how do you address those risks, right? Typical ways that you would minimize or mitigate that risk of material misstatement. I want to highlight that very first row, really emphasize we see the most errors and issues coming from completeness of a particular metric. And that may be a total listing of locations or assets. It may run into entity structure and joint ventures and reporting boundary, which we're going to touch on here in a moment, but also could be total emission sources, right? Fugitive emissions are a common topic of consideration in our assurance engagements. And so if you're early on in the process, or you're saying, hey, where do I start? Or what's my biggest risk, or something I should really spend a little bit of time on, really get comfortable with that completeness of your organization and make sure that you have a solid handle on what all is out there. So control descriptions, right? So as we think about those controls that we're designing to address the risks from the prior slide, they should really include, and again, this is best practice, and know we're all in an evolving industry with lots of grace and better tomorrow than we were today. Want to highlight that we should include the who, what, where, when, why, and how, to the extent it's applicable, right? To the right, we've highlighted an example of two controls, one from that financial reporting landscape, right? We've got, I think, 3/4 of everyone on the call has a finance and accounting background, which works out really well for us, as you can easily compare and contrast here. And then the bottom from an ESG reporting or an ESG control. The other piece that I think is important to remember, right, in the spirit of continuous improvement, is that those control descriptions should evolve over time, really mature as the reporting and control environment improves. Again, these slides will be available if you want to steal any of the risks or control descriptions as a starting point. So lastly, here's kind of what the final product looked like. So as you really complete your risk and control matrix, or your RACM, these are some real examples from RACMs that we see. It's important to prepare that taxonomy of your process and sub-processes, not to be confused with EU taxonomy, completely separate topic. And then we strongly suggest IDing both your risks and your controls, right? It might seem like a simple thing to do, but it really allows you to put some governance around what is my total risk register, what is my control register, and how do they map to one another. Many companies are taking the investment to house their RACMs within a system, right? Whether that be an existing GRC system or implementing a new sustainability specific software as well. I'm going to pass it back to you, Steve.
Perfect. Thank you, Nate. So a couple of things to touch on for RCM development. First, the walkthrough process is a very important part of fine-tuning a RCM or a RACM, risk and control matrix. So what you do when you walk through is you look at one instance of that control operating. So on that prior slide, there was the example of the review of the parameters used to run a report. So during the walkthrough, you would obtain the documentation of that review of parameters, and then the person walking through would document exactly what happened, how they get the report, how they document the review, and so on. And that's a good way to really fine tune that RACM itself. Another thing is it's important to identify who are the process owners and who are responsible for these different elements and the different parts of the process. So those are detailed on this slide as well. So you might be thinking, okay, how should we design our controls? Is there any guidance or any standards that help with designing controls? So your answer is COSO. So COSO is that widely accepted framework used for assessment of internal controls. So this is used for financial reporting, as many of you know, but COSO also applies for sustainability reporting themselves. In fact, COSO released a report called Achieving Effective Internal Control over Sustainability Reporting, which is supplemental guidance to show how you can use this existing COSO internal control integrated framework to sustainable business activities and information. And you can see here the 5 components of COSO: control environment, risk assessment, control activities, information and communication, and monitoring activities. And COSO is made up of 5 or so accounting and finance organizations, and it's been in existence for decades now. So COSO says a system of control is effective when each of those 5 components of COSO and all relevant principles, which there's 17 principles of COSO, are present and functioning. So present means that those components and relevant principles exist in the design and implementation of the system of control. And then functioning means that components and relevant principles continue to exist in the conduct of the system of internal control. So when you have both those operating together in an integrated manner, the system of control is effective. One thing that you'll likely hear assurance providers talk about is design effectiveness and operating effectiveness. So design effectiveness is whether the control is designed appropriately. So that's the value of the walkthrough, is to get a understanding of the design of those controls and be able to get comfortable with that. Operating effectiveness goes a step further, and it's testing the control operating over time. So you might test several months of the control operating, or test several instances of that control operating itself. We also wanted to hit on what are those key documents for internal control that we see for sustainability reporting. So the 2 that come to mind are SOC reports and the analysis behind that. So SOC reports are those system and organization control reports that software providers will release often, that it's really an audit of their software system itself. An external third party comes in and audits the system to assess whether the system is operating as expected. Are those controls that they have internally for the system, are those operating effectively or not? But the value as a user of that system is you can gain comfort that the system is operating as you would expect. And then also those SOC reports contain user entity controls, or sometimes called complementary user entity controls. And those are the controls that the software provider is saying you, as the user of the software provider, need to have in place for the software to be run effectively as it should. So reviewing those are really important. Those SOC 1 reports, those are focused on internal controls over financial data, where SOC 2 reports are focused more on the processing integrity. So it's a little bit more non-financial based. But you might use a SOC 1 report if you have spin-based data, like I was saying, used for your scope 3 calculations, for example. Another really important document is the inventory management plan, or IMP. So this document is flexible, but it often includes boundary information, methodologies and emission factor sources, information about data management, data collection, and the calculation procedures, who is responsible for doing different sorts of elements of sustainability reporting. Also, that base year recalculation policy. So is there a threshold? Are you using 5% as your base year recalculation policy to assess whether you need to restate your base year, which is what you're comparing your current year emissions or data to. And then also, what are you doing for assurance and what are you doing for internal audit, QC, quality control, and all those sorts of things. So there's checklists that you can find out there that have, here are the components that are part of inventory management plans, but they're inherently flexible. But IMPs are a good way to get the information that you need for disclosures. And once you have that boundary information, you can copy and paste that and use it for your external disclosures themselves. Okay, this slide has some technical details. So if you want information you can take back to your boss and impress them, this is the slide here for you. So there are 3 different types of organizational boundaries for greenhouse gas reporting. And really these are used for sustainability broadly, but this is the information from Greenhouse Gas Protocol. So first is financial control. So this is including 100% of the operations that the entity has financial control over. So this is really the same boundary as financial accounting. And I'll talk a little bit more about how that is. But other advantages of this include that financial control is the starting point for overall CSRD reporting. That being said, yeah, there's also operational control components of that. If you have entities that are under operational control but not financial control, you have to do some greenhouse gas disclosures there. Also, CDP gives you points if you use the same boundary as financial accounting. And if you follow the SEC rule requires financial control or an explanation of the difference. So there's been a lot of movements that make financial control a little bit more attractive than what it used to be. Off to the right, we have some commonly misunderstood categories for financial control that we wanted to cover. So like I said earlier, financial control is the same boundary as financial accounting. If your entity has group companies that report up to it, what group companies and subsidiaries are those are the fully consolidated companies themselves. So those are 100% of those emissions would be included within financial control organizational boundary, which is what is contained in your ESG disclosures themselves. Also, associated or affiliated companies are those entities that there isn't financial control. So those are the entities that aren't consolidated. And then third on that list, which is probably the most misunderstood, is non-incorporated joint ventures, partnerships, operations, where partners have financial joint control. So the key piece of information for this is proportionally consolidated. Proportionally consolidated entities are quite rare, especially under US accounting rules. So typically there aren't a lot of entities within a large corporation that are proportionally consolidated. So would encourage you to think through, okay, are those joint ventures, are those group companies or subsidiaries or associated and affiliated companies? And as most of the people on the call report within finance and accounting, this is where you can really bring value to greenhouse gas accounting and to the sustainability ESG team, is providing them information on this technical consolidation and providing them with the information that they need. Okay, that's financial control. Wanted to hit a couple things on those other 2 organizational boundaries out there. So operational control is including operation activity that the entity has operational control over. So this was really popular under voluntary reporting. And it makes sense from the perspective of why measure what you can't control. So we saw that be used fairly commonly. I think we're seeing more of a shift to financial control due to those different advantages I mentioned. And then also the third one is equity share. So equity share is the percent of operation activity based on the entity's percentage of equity in the operation. So this boundary is helpful if you don't have the ownership percentages, or if you have the ownership percentages of partially owned entities, but not the consolidation information. So if you don't know whether it's consolidated or not, this could be a helpful one. We see companies use equity share, but not to the extent that we see companies use financial control or operational control. So I know that's a lot there, but wanted to hit on that as that's a commonly misunderstood concept and a really important concept for internal control and for ESG reporting itself. Okay, wanted to touch on some important things here, and I'll keep this high level. One thing I wanted to mention is accountants are the keepers of the capital markets by auditing companies. And that's especially true since the Great Depression, where auditing really got more structured and a little bit more detailed. So large corporate structures make auditing more complex, which makes the organizational boundary itself more important and something that you need to pay more attention to. So within auditing, there's been methodology that has been developed and used that really helps provide assurance over these large entities, because that's a big part of the risk, is making sure that the proper entities and operations are included when you're doing those greenhouse gas calculations themselves. Okay, Nate, you want to talk about assurance readiness assessments?
Absolutely. And we're jumping around to a couple different topics here, so appreciate you sticking with us. We've got about 15 minutes left here. Common engagement we're performing for companies is a readiness assessment, or we sometimes use the term dry run. Given this is really a new reporting standard, doesn't have the 20, 40, 60 years of financial reporting and history behind it. Much of that data within sustainability is really unorganized, fragmented, might not be even there, and is really subject to estimates. A small but thorough examination of the readiness to pass a true insurance engagement is really what this readiness assessment encompasses. The slide on the screen runs through the typical process. It closely follows a true limited assurance engagement, but the outcome's a little different, where you've got gaps and recommendations for closing those gaps through best practices. And again, this is a very common, popular request that we're getting for companies before coming in, with the hope that a readiness assessment would identify any really challenges that they would have to pass limited assurance, and give a little bit of confidence to company management that when your first limited assurance comes through, you'll be able to pass with flying colors, hopefully. So beyond just, actually getting ready for assurance and identifying this gap, one of the reasons companies have really loved the readiness assessments is it allows you as a company to place particular emphasis on certain items, whether that be your IMP review, internal controls, executive training. They're a little bit more tailored to help you address some of maybe the broader gaps or opportunities for improvement within your organizations. The other cool part about these is the engagements can be completed over a prior full year of reporting if you've been volunteering reporting for a number of years, a partial year, say 6 or 9 months worth of data over your selected metrics, or the full year eventually subject to assurance. And we're not going to spend time on it today, but we'd be happy to connect with you after about kind of some of the pros and cons of each of those options. Okay, polling question number 3. I think this is our last polling question. Great transition over, second to last. I think this is number 3. It's going to be a great transition to Michelle, who I know you all have been eagerly waiting for. My guess is, as we're thinking about, is your organization required to comply with CSRD requirements? My guess is our audience is largely US-based, but curious how many have gone through that applicability analysis to understand if you're also, as a non-EU company, subject to CSRD reporting requirements. So we'll give here a minute. Michelle, any thoughts on guesses or predictions?
Yes, I think, like I said before, around even just thinking about assurance, probably if you've started thinking about assurance, it might be because of something like the CSRD, because it brings in this assurance. So I'm interested to see, it'll help me direct how I present what I'm going to present now.
Yes, and we're thankful to have Michelle from across the pond joining us today. I think you'll really enjoy what she has to say here in a minute. Okay, results are in. 10%, 1 in 10 issue consolidated, another 10% approximately for an EU subsidiary. Big portion saying not sure, almost half, Michelle, aren't sure if this applies to them. And then we've got about a third that says, hey, that's not my deal, I'm out of it, which hey, one less thing for you all to have to worry with. So anyway, with that, Michelle, I'm gonna turn it over to you.
Great, thank you very much. So I suppose what I will be really talking to a lot is maybe some of you who've said not sure, because I'm going to start off, before I go into the assurance requirements that come out of the CSRD, I'm just going to talk a little bit about what is the CSRD. So don't be alarmed if you haven't heard about it. Maybe some of you are going, what is that? Why did Nate just ask me that question? So as he referred to earlier, this is a new regulation that has been launched in the EU, but it does not just impact EU companies. It's got a far-reaching impact on many global businesses. So it's called the Corporate Sustainability Reporting Directive, and it requires initially large and listed companies to publish reports on certain factors and metrics and disclosures that are required. It was released in 2023, and the first year of effect for most of those large companies is 2024. So if you've got, for example, a December year end in the EU, you're going to be reporting now in the beginning of 2025 your first CSRD reports. They call them sustainability statements. So who does get included into the CSRD? First of all, as I said, it's the large and listed companies. So looking at companies with more than 250 employees, net turnover of over 50 million, and over 25 million of assets. They need to meet two of those three criteria. Then you're looking at listed SMEs following on from that. And then the one that is going to be most interesting to you, which is the non-EU companies. So if you're a non-EU company, but you've got operations in the EU with turnover of greater than 150 million, or you have at least one subsidiary or a branch there that generates turnover over 40 million, you could be scoped in. There's a lot to consider in terms of the scoping requirements. So the first thing you always need to ask yourself is, well, do I have operations in the EU? And from there, there's a lot of processes you have to go through to see how you get scoped in. So the CSRD, which is the regulation, is based upon European reporting standards. So the best way to talk about that is to compare that to IFRS or the US GAAP. So the requirements of reporting are sitting in these 12 standards that have been prepared by the European Commission. There are 12 standards that are in effect, but the first two are cross-cutting standards. So those ones are really important in terms of the first steps that you take in terms of CSRD reporting, which is around something you might have heard about, which is a double materiality assessment that has to be done. And the requirements for your double materiality assessment come out of the initial ESRS. But what do these statements really go through is they're in the three categories, as you would expect. A whole lot of standards under environment, which is still the most important one that most companies are focusing on. The second one is 4 standards under social, the S, and then 1 sitting under governance. And it requires you to look at disclosures across these different elements. Around governance, for example, would be looking at what processes, controls, or procedures are used to manage and oversee sustainability in your business. And that can include what committees do you have in place to do that. It's looking at strategy and your business model. I think this is a really important one because nothing in the CSRD doesn't link back to the overall strategy of a business. So gone are the days where you can just say, oh, sustainability is something we do on the side. It needs to be more integrated into the strategy of the company and the business model in order for you to comply with a lot of this regulation. And then a really important thing you will hear about is the impact, risk, and opportunities, what we call IROs, and how you manage those, because those are what ultimately determine what you're going to report on. So your material impacts, risks, and opportunities that you have identified that are relevant to your business will determine what you ultimately report on. So it's not a case of everybody reporting on everything. It's very client-centric in terms of what is important to you as a business. And then policies, actions, and targets. We all know that sustainability is a forward-looking, everything about sustainability is forward-looking. You know, we all used to, and most of you come from the financial world. It's historical. You're reporting on historical information. Yes, there's certain elements that look forward, but sustainability is really about looking forward. And because of that, you have to put in place a lot of targets that you need to then monitor to see your compliance with. So what really does this mean from an assurance perspective? And this is why I said earlier that you really would expect to see more and more companies starting to do assurance. Previously, we just had a lot of voluntary assurance happening, But as there's a view to this becoming potentially an impact on your business, everybody needs to consider when they're going to have to apply assurance. So the CSRD came out of something called the NFRD in Europe, where there was a requirement to report certain information. There was no assurance requirement for that in Europe, but that was what was initially there. Then when you move to the CSRD, as you heard from the team earlier, limited assurance is the first level of assurance that is required under the CSRD, and it's required, which means that once you issue your sustainability statement under the CSRD, you are going to need to have limited assurance over that. And your prior year figures do not need to be assured. It's the first year of application that's relevant. And then there is a lot of talk about this move to reasonable assurance, and ultimately from the CSRD perspective, that could be in 2029. We don't know exactly yet if that's when it will happen, but there's still a lot of talk about what that will look like. So I think we've got a polling question before I get to my very last slide. So let's go into that quickly about, oh gosh, this is about the topics we will talk about in the future. So if you're interested in talking to us, you've got a few more seconds to ask.
And we're getting real close on our time here, Michelle. I might just quickly mention there was a number of questions that came through the chat. I know Steve snuck one in there. For those of you that we haven't had a chance to chat with, we'll follow up with you individually. And again, thanks for your interaction. Did we miss the polling question there? Did we go ahead too fast? Trying to see where we are.
I don't think we're going to be sharing the results of that, but if you did answer, we'll get back to you. So let's just look at, from what I've said now, just to close off in terms of the CSRD, what needs to be assured. So as I mentioned, the first thing is your double materiality assessment that needs to be done. And if you're a global business, you'll be doing this often either at a consolidation level in the EU, or you could be doing this at a group level globally. The process that you've gone through needs to be assured. The second element is all those disclosures that you're going to make. Those need to be assured. The standard that is applied to that will be, specific to the limited assurance. Then your EU taxonomy, as Nate referred to earlier, there's so many different taxonomies that are being referred to. This taxonomy is a specific one that comes out of the regulation under the CSRD and Article 8. And then you've got your ESF tagging. That also needs to be assured, but at this stage, there's no guidance on that. So for most companies, this is something that they're not really considering at this stage. We even think that might be excluded going forward. So really importantly, just talking about that readiness and those pre-checks and the pre-assurance that you can do. Again, we really encourage companies to do a pre-assurance on DMA, because it is such an important thing to determine what you're ultimately going to report on. So you want to make sure you're going to get that right to ultimately do that reporting. So CSRD is going to impact on many, many global businesses. Don't ignore it. If you don't know enough and you want to talk to us, that previous question was about that. Talk to us and we can help you understand your scoping.
Michelle, thanks again for joining us. And Steve, thanks for co-presenting with me today. Really hope that you enjoyed our webinar here today. Our contact information is on the screen. Please feel free to reach out to one or all of us individually. And with that, we'll let you get back to your day. And thanks so much for joining.
Thank you.
Bye. Thank you, everyone.